Hey folks, Dan Frio here with your market update for October 1st, 2024. So mortgage rates ticked up just a little bit yesterday. That's going to be news of the past because right now we're focused in on right through here. This is what's taking on the chin in the equity markets, but is actually helping out the bond markets right now. You have Iran up through there looking for a direct attack on Israel. This is going to stir up a hornet's nest, and who knows where this is going to go. They're also predicting, there was the strike, the port strike just started, and they're saying if that lasts a little too long, that will push us into a recession. So we have major events going on right now. So this is a good learning tool right now because you're going to start hearing moving to safe havens. Okay, so here's what the markets are talking about when you start hearing those things. Usually when events like this happen, what will happen is the equity markets, stocks will take it on the chin. People move out of the stock market and move into safe havens, which are bonds. Okay, so we'll probably see an uptick in the bond market today and a downtick in the equity markets if markets are normal. So we're going to focus in on that as we focus in on the rest of the data for today. So let's get over to the calendar that we have. We have manufacturing numbers coming in and the JOLT index. The JOLT index is how many job openings there are, and that upticked a little bit, which is good news or good signs for the economy on the employment front. So now let's look at some of the manufacturing numbers. We had the manufacturing PMI was in 47, stayed steady at 47. Manufacturing PMI was 47, stayed steady at 47. This is September. This is ISMs. And then the ISM manufacturing prices went from 54 to 48. That should be a nice little uptick in the market there. And then the JOLT index is also some good information for us there. And then tomorrow we're going to get the ADP payroll numbers. Thursday and Friday we're going to get more employment numbers and wage growth in those areas. So that's what we're seeing right through here. Let's go over to the bond market, seeing how that's reacting. That is up, like I said, because we've taken it on the chin right now in the equity markets. So we have mortgage bonds right now. They are they are up 12 ticks. What does this mean? Well, it actually means mortgage rates are going to come down. Okay, so how do you understand this? Here's the price of the bond right up through here. If the price goes up, rates come down. Price goes down, rates go up. So we liked up 12. Is it going to go up more? Well, it just ticked up 15 if you just paid attention there. So we're having a nice rally in that market as we speak right through here. Some good information that was just came out the other day was wages versus inflation. And you're seeing this wage growth is starting to outpace inflation nationally. So I know a lot of you guys are like, Dan, I'm hurt and I'm this and that. Folks, this is national numbers. There might be little pockets or you might be struggling a little bit more than the next guy, but these are the national numbers for all of us throughout the entire country. You're going to see through there. Back in 2022, it was kind of inversed, but right now we have wage growth on top of inflation. That's how it kind of should be. So you can have that appreciation in your dollar, and you can afford more things as things go on. So I do have some interesting information to show you guys. Last night or yesterday, Federal Chairman Powell met in front of a few places, and it was an economics committee. I'm going to show you his interview here, and this is basically his opening speech, and he gives us a lot of data because most of us, and especially me, I want to know the direction of the Fed. What is their thinking? So I'm going to play this video for you, and it's very important because this is the Fed. He opens up and tells us basically the state of the markets right now and everything else. But then I had a hidden piece of analysis when he had a sit down with this committee, and I'm going to show you that as well. He actually comes out, and I don't know if he meant to, but he comes out and tells us actually how much the Fed is planning to cut, and it doesn't meet market conditions. So let's get over to right through here. We see the stock market right now, like I said, taking it on the chin. But here's where the cuts are coming from the Fed. They're supposed to cut tremendously between now and December of 2025. I don't think they're going to cut this much. That's me. I'm usually on the pumping side of things. In this one, this is a lot of cuts in a year's time. So let's get over to Chairman Powell. You got to pay attention to this because he wraps up all of the data into this speech. And then we come back. I'm going to also show you one segment. It's basically about 2 or 3 minutes into this conversation with this young lady where he comes out and actually tells us what their cut plans are. So let's get to the video. I hope you find interest in this. So take it away, Federal Chairman Powell.
I do have some brief comments on the economy and monetary policy, and then I look forward to our discussion. Our economy is strong overall and has made significant progress over the past 2 years toward achieving our dual mandate goals of maximum employment and stable prices. Labor market conditions are solid, having cooled from their previously overheated state. Inflation has eased, and my FOMC colleagues and I have greater confidence that it is on a sustainable path back to 2%. At our meeting earlier this month, we reduced the level of policy restraint by lowering the target range for the federal funds rate by a half percentage point. That decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in an environment of moderate economic growth and inflation moving sustainably down to our objective.
Okay, so just remember, this is from yesterday. It was yesterday. So all these numbers through here, these are yesterday's numbers. So don't look at these saying, whoa, my stock's rallying even more or my stock's crashing even more. So this was a speech from yesterday.
Turning to the labor market briefly, many indicators show that the labor market is solid. To mention just a few, the unemployment rate is well within the range of estimates of its natural rate. Layoffs are low. The labor force participation rate of prime age workers is near its historic high, and the prime age women's participation rate has continued to reach new all-time highs. Real wages are increasing at a solid pace, broadly in line with gains in productivity. The ratio of job openings to unemployed workers has moved down steadily but remains just above 1, so that there are still more open positions than there are people seeking work. Prior to 2019, that was rarely the case. Still, labor markets have clearly cooled over the past year. Workers now view jobs as somewhat less available than they were in 2019. The moderation in job growth and the increase in labor supply have led the unemployment rate to increase to 4.2%, still low by historical standards. We do not believe that we need to see further cooling in labor market conditions to achieve 2% inflation. Turning then to inflation, over the most recent 12 months, headline and core inflation were 2.2% and 2.7% respectively. Disinflation has been broad-based, and recent data indicate further progress toward a sustained return to 2%. Core goods prices have fallen 0.5% over the past year, close to their pre-pandemic pace, as supply bottlenecks have eased. Outside of housing services, core services inflation is also close to its pre-pandemic pace.
This is where the port closing down is going to play havoc, complete havoc on the market if it continues.
Housing services inflation continues to decline, but sluggishly. The growth rate in rents charged to new tenants remains low. As long as that remains the case, housing services inflation will continue to decline. Broader economic conditions also set the table for further disinflation. The labor market is now roughly in balance. Longer-run inflation expectations remain well anchored. Turning to monetary policy. Over the past year, we have continued to see solid growth and healthy gains in the labor force and in productivity. Our goal all along has been to restore price stability without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While that task is not complete, we have made a good deal of progress toward that outcome. For much of the past 3 years, inflation ran well above our goal, and the labor market was extremely tight. Appropriately, our focus was on bringing down inflation. By keeping monetary policy restrictive, we helped restore the balance between overall supply and demand in the economy. That patient approach has paid dividends. Inflation is now much closer to our 2% objective. Today, we see the risks to achieving our employment and inflation goals as roughly in balance. Our policy rate had been at a 2-decade high since the July 2023 meeting. At the time,
when he's talking about the policy rate, he's talking about the federal funds rate that the Federal Reserve controls.
At the time of that meeting, core inflation was 4.2%, well above our target, and unemployment was 3.5%, near a 50-year low. In the 14 months since the July 2023 meeting, inflation has moved down and unemployment has moved up, in both cases significantly. It was time for a recalibration of our policy stance to reflect progress toward our goals, as well as the changed balance of risks. As I mentioned, our decision to reduce our policy rate by 50 basis points reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate economic growth and inflation moving down sustainably to 2%.
So that's basically his speech there. So what I want to go over to is now a young lady from the panel, she starts to interview him. And he comes out and tells us basically how much they plan to cut. It's not directly, and he comes out and says, well, here's what, if the data comes in and it's just in line, and he tells us what they're going to do. So let's take it from the beginning. I think it's about 3 or 4 minutes in, just to give you the context up to that point. And she asks him basically just the direct question. So let's take this away. But sorry for all the videos today, but this is basically right in the wheelhouse. As Federal Chairman Powell comes out, he doesn't come out and talk a lot. So when he does, we have to listen to what he has to say, because basically the whole world is. And that's why we do this.
0.2% today to 4.4% by the end of the year. So continued drift upward. And yet the median expects that the pace of rate cuts will move down as the unemployment rate continues to move up. How do you square that picture? How do you explain that?
Well, remember that the summary of economic projections is really just a tabulation of the individual 19 participants. So it doesn't come from one sort of consistent thing. But I can tell you why I think people will have written up a couple more tenths of unemployment. It would just be that, as we've seen, the level of job creation is maybe not quite at the level it needs to be to hold unemployment constant, given assumptions about supply. That would make sense to me. I think everyone at this point is looking at their forecasts and understanding that there are great uncertainty bands around it. But the SEP asks you to write down your most likely case, whether you want to or not. And so that's what it is.
So it's sort of a love-hate relationship with the summary of economic projections?
That's not unfair.
Not for you personally, but yeah. Is there
I would say it's sometimes people can pay too much attention to it. I will say, though, one thing is we do it, as this audience well knows, we do it once a quarter. And over the course of a full quarter, the old SEP can get pretty rusty, But for a few weeks after the meeting, after we write down the SEP, it's actually a pretty good read on what the thinking of the committee is. And one thing I will point to is that if you look at the path that people wrote down, we had 10 people at 4 cuts or more, or 2 remaining cuts. We had 19 people at 3 or more. But the sense of the committee, this is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. And
this is what the markets took yesterday and said, whoa, they're not going to cut 50 basis points going forward like at all the meetings. And the market kind of pulled back on it. What we're seeing the market pull back today is the Israel situation. But let's continue with this.
If the economy slows more than we expect, then we can cut faster. If it slows less than we expect,
Here it
we can
comes.
cut slower, and that's really what's going to decide it. But I think from a base case standpoint, we're looking at it as a process that will play out over some time, not something that we need to go fast on. It's more, it'll depend on the data, the speed at which we actually go.
Yeah. So before I get to that second question on the unemployment
Here
rate,
comes.
I'm going to ask you a point-blank question here. How are you thinking about the November meeting?
So a couple things. One, we have 2 employment reports and an inflation report coming in. So the main thing will be to look, when we get to that meeting, at the totality of the data, and we're looking at the activity data, the unemployment data, and the inflation data, and asking ourselves, is our policy stance in the place where it needs to be for us to best foster achievement of our goals? And I think we'll take everything into account, and we don't have that data yet. So that's the main thing. But the other thing is just I wanted to point out, and I kind of just did, that it's a committee that we will do what it takes in terms of the speed with which we move. But if you look at where we were 2 weeks ago, coming up on 3 weeks ago, I guess, when we wrote down our SCPs and made our decision, it was a situation where people were thinking, the bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data, but ultimately that's what the baseline is. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
So he just said it. He said, if everything goes as planned, there's going to be 2 more cuts, and they're going to be 25 basis points apiece, equaling 50. So it took a long way to get to there. I was wanting to know his thought. And so that drives us into that where we are right now. So that is the news that we have for today. Let's get over and take a final read on the MBS market. It is up 13. Stock market's still taking it on the chin. Dow Jones down 348. S&P down 72. NASDAQ down 361. Let's see what crypto's probably getting hammered. No, not that bad. Only at 62.5. Oil should be spiking, as we know, and it's up to 3% right now on those fears. So we're going to see how all this transpires. But again, now you understand the safe haven, what that means when investors are moving from stocks into equities because of uncertainties in the world. And now we really have a more certain bead on if the inflationary numbers come in and the employment numbers come in as expected, we're going to see 25 basis cut points by the Federal Reserve going forward. So that's our report for right now. I'm going to show you how I'll be back at the closing bell to let you know how all this mess settled in for the day. So thanks for watching, guys. God bless. Here's where we're seeing mortgage rates right now. They're going to tick up a little bit more today. I'm sorry, they're going to tick it a little bit down today. So we should be back in maybe the 6.1 something range by the end of the day. So I'll be back at the closing bell to let you guys know if we hit it. Thanks so much for watching, guys. God bless. All I ask you to do is one thing. Either give me a thumbs up or subscribe to the channel. That's all I ask of you. Take care. See you later. Bye-bye.